Hey friends, welcome back. Iggy here from the Investing Iguana, where we break down Singapore stocks in plain English so you don't have to lose sleep over all that finance jargon. Today, let's walk through a story that might surprise you. BRC Asia. If you've ever looked around and wondered who's actually building Singapore up, think HDBs, MRT lines, Changi Terminal 5, well, BRC Asia's right at the center of all that action. Maybe you're eyeing stable income stocks, or you've heard talk of construction sector booms and want some clarity. Trust me, you're in the right place. We're diving into a quick company snapshot and why BRC Asia matters now, what's good about the business, 3 eye-openers, the red flags that every investor should note, my honest take, verdict, and what I'd watch for if I were in your shoes, and if you stick around, the key takeaways you can actually use, CPF, SRS, portfolios, and all. If you're new here, just know this. I've spent years unpacking Singapore investments, so you get a clear, honest view that fits our local realities. Let's walk through this together, step by step. All right, so who's BRC Asia and why is it in the spotlight? BRC Asia, founded back in 1938, is Singapore's biggest name in steel reinforcement. Think of them as the hidden backbone behind almost every HDB flat, mall, tunnel, and major infrastructure build. Their factories aren't just here, they're in Malaysia and China too, and they process over 1.2 million metric tons a year. That's massive. What's happening right now? Well, in the first half of FY 2025, BRC pulled in 715.6 million in sales, which sounds like a dip, down 6%. But here's the twist. Net profit actually rose 9% to $42.1 million thanks to some tight operational moves. Cheaper steel prices hit revenue, but smart cost control boosted actual profit. The really juicy part? That Terminal 5 win. It's $570 million for Changi's next superstar airport hub. That single-handedly pushed BRC's order book up to a record's $2 billion. To give you an idea, that's about 1.4 times what they made in all of FY 2024. So even if nothing new comes in, they've got revenue visibility stretching well into the decade. And for the Singapore focused among us, yes, BRC is CPF and SRS eligible, pays a 4.9% dividend at a healthy 39% payout ratio, and offers exactly that mix of boring but brilliant stability we tend to crave. If you could see the valuation table from the article, it basically says, BRC trades at a modest premium, but with good reason. The combination of backlog, regular payouts, and not being overloaded by debt puts BRC in a sweet spot for steady defensive returns, especially when things out there get wobbly. So first up, let's talk the 3 good. This is the fun part. Good number 1, record order book equals unprecedented earnings visibility. Look, $2 billion is a gigantic number for any construction player here. Terminal 5 alone is 28% of that pile, meaning BRC has work lined up till at least 2029 and possibly beyond. In a sector that's often at the mercy of short-term cycles, this sort of long view is rare. And the rest of their order book? It's a healthy mix. Think HDBs, office towers, other infrastructure. That spreads the risk. So BRC isn't just betting everything on one big project. If I can offer a tip, for a stock like this, don't just watch quarterly profit. Track order book completions and renewals. Are the big wins being replaced by new ones? Good number 2, dominant market position in a resilient SG construction scene. BRC controls 55 to 60% of Singapore's steel reinforcement market. That's like having the lion's share in a small but fiercely protected jungle. It means pricing power, decades of customer trust, and built-in regulatory relationships. And with Singapore's construction spending predicted to stay strong up to 2029, thanks to more HDB launches, ongoing MRT expansions, and big renewal projects, BRC's capacity lets it meet sudden jumps in demand without breaking a sweat. Another tip for you. If you want to lead on future orders, keep tabs on government announcements, especially the BCA forecasts and HDB rollouts. Good number 3, operational leverage, kicking margins up a notch. Here's where things get surprisingly clever. Even though revenue dropped 6% because of weak steel prices, net profit jumped. Why? BRC slashed its operating expenses by 16%, trimmed down financing and FX costs, and saw margins improve to nearly 6%. In fact, their Q3 saw volume spike 22%, even as steel prices tumbled 14%. That means they're getting more out of every dollar. The recent acquisition, Southern Steel Mesh, should add even more process efficiency in the coming year. One last nugget. Watch how BRC's gross margins move compared to steel price shifts. If margins keep rising while prices fall, you know they're running a tight ship. But hang on, every investment has its flip side. Let's run through the 3 red flags. Red flag number 1, steel price volatility squeezes margins. Even with stable project volume, BRC can't control global steel prices. In 1H FY 2025, that meant a 6% revenue fall, and in Q3, a sharp 14% drop in steel prices. That shrinked gross profit margins to just 9.4%, and BRC had to make a $7.7 million provision for some rough, long-term contracts. When they lock in prices but steel gets expensive, it can really sting. Some contracts let them pass on higher costs, but not all. Quick tip for the savvier among you: track steel futures and management's quarterly margin outlooks. It's your early warning system. Red flag number 2, high customer concentration and project risk. Terminal 5 isn't just a trophy win, it's a concentration risk. With almost a third of current orders tied to one mega project, any delays or changes can hit BRC's books hard. And Singapore's small market means few buyers, limiting new deal options. Payment delays or trouble with just one major developer could also pinch working capital. Best practice: whenever you see updates, check for order book diversity and Terminal 5 milestones. Red flag number 3, growth means big working capital needs. BRC's balance sheet is solid, but as the business grows, so do funding needs. There's $147.9 million in trade receivables and $237.9 million in short-term debt. That makes BRC dependent on everyone: developers, clients, suppliers, getting paid and paying up on time. Their debt EBITDA ratio is a safe 1.4x. But if anything goes wrong, like project delays or sector slowdowns, liquidity could tighten fast. Quick tip here: watch quarterly trade receivables versus order book levels, plus how much cash and borrowing BRC keeps on hand. By the way, if you want all the numbers, tables, and my full checklists, hit up the Substack article, link below. It's packed with visuals you can reference anytime. Now back to our journey. What would push my view up or down from here? Upside: another $300 million mega project, or if gross margins hold above 11% for at least 2 quarters, or smooth integration of that Southern Steel Mesh deal by next year. Downside: if Terminal 5 faces big delays, or if margins dip below 8% for 2 straight quarters, or if net debt EBITDA climbs past 2.5x because of slower cash flow. Here's my honest take as Iggy, both the educator and the investor. BRC Asia, right now, offers some of the best visibility in town for earnings. Construction is often a wild ride, but Singapore's pipeline till 2029 is rare stability. The combination of a record order book, dominant market share, and margin improvements make it worth a core spot in domestic portfolios, especially if you use CPF or SRS. The dividend, 4.9%, is another cherry on top. But, and it's a real but, steel is still a commodity. Prices swing, and mega project exposure still means risk. For me, position sizing here matters. Medium-sized, not all in. Watch margins, watch order book flow, and if you see price dips due to short-term steel volatility, consider accumulating slowly. Entry points around $400 or $420 look compelling, given current valuation and earnings certainty. But always watch those quarterly numbers and big contract wins or delays. Imagine this decision frame. Think of it like a pilot's dashboard: order book growth, gross margins, net debt, and project milestones. That's what I track. You should too. So, what's the main thing for Singapore investors? BRC is a window straight into the country's construction boom. The huge order book, including Terminal 5, gives unusually clear earnings visibility. CPF/SRS eligible, solid dividend, manageable risk profile. Yes, watch for wild steel price swings, but the market leadership and conservative balance sheet set a strong foundation for growth through 2029. If you're thinking about your next portfolio move, here's what I'd keep in mind. Don't chase hot news. Chase real visible business momentum and use the tools, order book reports, government forecasts, margin guidance to help you decide. Let me know your thoughts down below. Are you watching construction stocks? What's on your radar this month? And hey, if you love this kind of Singapore deep dive, consider joining the Investing Iguana membership. You'll get early access to all my market breakdowns and guides, plus a smart, supportive community of local investors. Find the details in the description below. For your next watch, check out my video on Singapore REITs, yield traps and opportunities. It'll give you a broader view on local income stocks and how they stack up against BRC Asia. Thanks for walking through this with me. Happy investing, and I'll see you in the comments.